Bring in our market panel. Joining us now, Barbara Doran from BD8 Capital Partners and Paul Hickey from Bespoke Investment Group. Good afternoon, guys. Paul, if the economic data, the labor, the jobs data tomorrow morning isn't shocking, what are the details you'll be looking at beneath the surface to help determine where stocks and yields go from here?
So I think what you're looking for is the labor participation rate. You're looking for average hourly earnings. You don't want too much growth there. But what we're overall looking for is what we've seen in these September reports, or for August at least, the reports in September is 3 out of the last 4 were stronger than expected. So that's something to keep in mind here. But I think beneath the surface, we keep talking about hard or soft landing, and it's really difficult to tell in the moment which you're going to have because they look very similar. You tend to see rising jobless claims. You tend to see falling bond yields. You tend to see lower oil prices because they're both in the early stages a weakening economy. It's whether or not they expand to further weakness. And at this moment, we're not of the view that we're going to really see the hard landing within the next few quarters here. And we're more of the view that we're going to get a softer slowdown in economic data.
Barbara, anything that you've seen in the earnings numbers shaking you as we look ahead to these important jobs numbers in the morning?
In terms of individual companies, I think it's really been company by company or sector by sector. In retail, it has been company by company. We look at Dollar General versus Walmart, similar sales on the top line, but very different business models and reaction to what they're seeing, or in the semis, in the AI, there's been a lot that has gone well there. So, and you're not seeing estimates come down for next year. This is really about the time of year where companies will start to put out little feelers and letting key investors know that things may be troublesome. But it still looks like earnings growth for next year could be in the 12, 13, 14% range. And certainly this last quarter was pretty positive. So, I'm with Paul. I don't see a lot of slowdown evidence here. I mean, continuing claims this morning, initial claims, were fine. And all the underlying, the ADP number missed, but even there, it's not about layoffs. It's about labor normalizing, wage growth slowing. And that's been happening all along. I mean, tomorrow's number will tell us a lot, but it's, I think, very unlikely, given all the other information data we've had, that you're going to see a big one-off miss like we had in July.
Paul, I realize that September is seasonally the weakest month of the year, so there's probably that at play, the seasonality, the technicals that come along with that too. But isn't the bond market signaling greater recession fears here? And how much do equities actually take their cue from that the longer that plays out?
Yeah, we have seen bond yields fall here over the last few weeks. Like I said, though, during any period where you're seeing slower economic growth, you tend to see yields decline. What would really concern us much more is if, coupled with the fall in bond yields, we saw high yield spreads start to widen out. And we're definitely not seeing that. And when we look at breadth in the stock market a lot, but if you look at breadth in the high yield market and high yield bonds, what you're seeing strong breadth in that market, stronger than what we've seen in the past few years here. And so that's a positive signal, because if the market was really getting concerned about growth here, you'd see lower bond yields and higher spreads. So this whole view that we're seeing weakness on economic concerns, this week's economic data hasn't really been that bad. Manufacturing PMIs were weaker than expected. Services, much bigger part of the economy, slightly accelerated month over month and was stronger than expected. So I think it's much more to do with seasonality. The last 4 Septembers, we were down 3% in each of those Septembers. So, I think investors are just, looking ahead to next year. Taxes are most likely going to be the same or higher, so why not take some profits?